Good afternoon, everybody. Today is Wednesday, the 26th day of this terrible month for longs, May that is. We've seen this market down, I don't know, I don't remember what the numbers are, but I think we're down about 11% or so in the S&P 500, 9% before today, and add another 2/3% on top of that. It just gets worse by the day here. There's really not a lot to be encouraged about. Today we did see that surprisingly that the advanced decline line had held positive throughout the session, but wasn't obviously the advanced decline line. What I was trying to say was the advanced decline line is a nice piece of information and a lot of times can help us with our directional bias during the day, but once the market starts breaking down, doesn't matter how good that advanced decline line is. Just the opposite. Sometimes you have a weak advanced decline, but the market starts rallying. So, anyways, let's take a look at the 1-minute time frame. We had we'd started out with a gap higher, and it was looking like there was the possibility of the sketch I had drawn last night maybe coming close to what we had seen. Now, let me explain this drawing a little bit here. What I was looking at was that the market was due to gap up above this 5-day moving average. And I was looking at a pullback below the volume weighted average price, and then a rally that would continue up towards those prior highs. And what those prior highs were, let's take a look at that 10-minute time frame. What I was looking at was a gap up above the 5-day moving average, and then a continuation, that little pullback, and then a continuation up towards that 109.80 area. So that's what this red line represented, and then a shakeout below VWAP, and then continued strength into the close. As I had said, it wasn't meant to be a blueprint for trading today, and in fact obviously didn't turn out to be one. So we had that initial pullback below VWAP, and my best trade of the day was right there, and I had spent a lot of the day just kind of chopping back and forth and then being frustrated with the market. So I quit early and didn't participate in any of this decline. What we've seen the last 2 days in particular is right around that 1:30 time, we've had kind of a false move. So today we had this break, and I got long in there thinking that, well, as long as it, getting above that 109 level, I thought that it would get above and, hold above this area at first, and then I said 108.85, so I bailed on the trade right there. So it looked like it was above the volume weighted average price. We had a strong advanced decline line, but I had a stop on it, and unfortunately the only thing I did wrong was not to reassess this and say, hey, from this failed breakout here this afternoon came this faster move lower, and then we had seen the bigger, the secondary move even further. But the point I was trying to make is we're at about 130 yesterday as well. Yesterday it looked like the market was going to break down 130, 145. The market looked like the S&P was maybe going to try to break down through the volume weighted average price, and there was a much bigger rally at the end of the day that continued on the to follow through from the gap higher yesterday. So Steve Spencer at SMB Capital, who I had the pleasure of golfing with, he and his partner and Today Trader last week, had a post last night, and he basically said, if you have a tough morning, don't worry about it. That this market is giving us a second opportunity in the afternoons, and that really, if you trade an IRA, for instance, don't trade all of your equity in the morning, because there's been some fantastic opportunity in these afternoons. So the afternoon moves have been sharp and fast. Today we closed, unfortunately for those who are looking at last Thursday's gap lower or something we're going to recover from, we did close below this 108 level, and this gold moving average represents the 5-day volume weighted average price. So since this event, that is, what's the volume weighted average price been? And that's what we're looking at. That's the let me just reconfigure here. I'll draw it on here so you can see how it occurs. So if we take the volume weighted average price trend tool and start it right here on the 20th and drag it straight across, you can see right there at 108 is where it ends up. So we're still on average from the gap lower last Thursday, the average participant is still losing money. Now, it's been a real choppy environment, and I think it was Joe Fahmy at the end of the day said here today that, you know, swing traders, it's a waste of time, you're just getting chopped up. For day traders, it's a great environment if you're on the right side of it, and that's the thing, is it requires that, you know, that this volatility that we've seen, this continued volatility, is just a fantastic day trading environment. There has really not been a better day trading environment in quite a while. The thing is, though, that is as good as this environment is, you have to be right on. You have to be thinking clearly. You have to be engaged, and you can't be stressed out about other things. And I'm kind of speaking for myself here, at least, because today I feel like I missed a huge opportunity. You know, lost a little bit of money. It's nothing that's gonna, you know, hurt me, but I'll be back for, you know, by Friday, I'm sure, and have an up week. But it just feels like a waste when you see this incredible volatility. Now, where are we overall is what we really need to take a look at as well. When we take a look at the year lows for the S&P 500, they were made on February 5th, I believe, is the level there at 104. Let's take a look. I think it was the intraday low. Pull this up too so we can see it. February, I don't know why I said May, but February 5th, the low was 104.58. Yesterday we undercut that by 20 cents, and then we had seen that nice reversal higher. So what we've seen here, you know, and again, this is part of what I think is the market starting to accept these levels and to try and build some support, is we are seeing at least out of the last 4 sessions that the heavier volume, and I guess that's not fair to say, but out of the last 5 sessions we've had 2 heavier volume days. The heaviest volume day was last Thursday. Okay, then we tried to stabilize on Friday on heavy volume. We tried again to stabilize yesterday on heavy volume. Monday and Wednesday this week, we've seen the lighter volume. But if you take a look at the volume weighted average price for this week, that is the 3-day volume weighted average price, we couldn't close above that today, right at about 107.50. So we're still, you know, these gyrations we should expect to continue to come here. We have a lot of external factors that are affecting people's overall view of the market, from you know, does this market even work, to catastrophes like you know, what's happening in the Gulf that just make everyone sick to their stomach. I saw someone today on television saying that, you know, they thought this was an overreaction in British Petroleum. I don't think, you know, my personal feeling is, and that's why I'm not trading it, I don't think it's an overreaction at all. I think these guys should be out of business for what they do, and if the government holds them fully 100% accountable for all the damages that they've caused, that it's going to cost who knows what it is, but it's going to go on for a long time, and they deserve to go the way of Union Carbide after Bhopal, India in 1984. So I don't usually go off on little rants, and that wasn't much of one, but anyways, it's just, you know, there's a lot of reasons that people are looking at this market and saying, why even be involved? We're below the 200-day moving average. As I said in a post last week, I believe it was last week, you know, the typical, it's not typical for the market to just completely cave in once it goes under that 200-day or 40-week moving average. Here we're looking at 205, you know, 2005, 2004, 2006. We've seen a lot of undercuts of the 200-day moving average. When it really is damaging is once we've seen all these moving averages cross back and forth as the 10, 20, 30, and 40, and we have the shorter term moving averages below the longer term moving averages, and then that 40-week moving average starts to decline. That's typically what represents the end of a bull market. Now, where we are today is that these levels are still going to continue to be important, and obviously, and maybe we go back and even down towards the 101 level from back in September of last year. But if we were to see a, you know, we could even say, and it's just kind kind of foolish in a way to do this, but if we were to see a rally that maybe got us up towards 112, 113, I don't know what would get us there. But again, it's easy to be bearish, and a lot of times when it's easy to be really bearish, that's when the market turns higher. When it's easy to be very bullish, that's when the market turns lower. It's easy to be bearish, and we've still got a market that's not fully in a downtrend on the weekly time frame. Now, I'm a short-term trader, so I'm more focused on the shorter term time frames, but we still have to be aware of that bigger picture. So there is still value in it, and this 105 area is going to continue to be important. If we take a look at the 10-day chart using 10-minute candles here, we've got this 5-day moving average, and this is what I was hoping we would hold above, test this resistance, and then build the energy for a push higher, perhaps up towards the 200-day moving average at 110.5. Obviously, that didn't occur, and you have to remain flexible. You have to remain open-minded. Anyone who comes into these markets with this feeling that, hey, we're definitely going to rally and I'm going to get long and we've made a bottom, you're just asking for trouble. At the same time, anyone who comes in and says, hey, it's over, we're going back to 85, you're going to get your head ripped off in these bear rallies. So my TV's on mute. That's interesting. The National Weather Service still comes in to tell me there's a tornado warning, and the skies do look that dark out there. So anyways, the S&P 500, we're searching for stability here above the 30 let me just turn that off, 105 level, and it's going to need to settle down before we can really take a look at more swing trade type opportunities. The Nasdaq, the Qs, the Nasdaq 100 is trying to stabilize and hold near this 200-day moving average. It's not, it's just a battle right there, and this is just, this is the area where the battle's being fought. A lot of people have, been saying, well, as long as we hold the 200-day moving average, and one day they say, well, we're bearish, we're bullish, we're bearish, we're bullish. It's not as simple as the 200-day moving average. We still have, in all these markets, declining 10, 20, and 50-day moving average, which says these markets are going to need some time to stabilize, and a test of 43 wouldn't be unlikely. 42.5, 43 in the Nasdaq. We've still got you look at the 65-minute time frame, we've got a declining 10, 20, and 50-day moving 20-day 5, 10, and 20-day moving average, just like we do in the S&P 500. So any of these rallies, and I've been very clear about this, anytime I talk bullishly on Twitter, I hope that the people who are following along are looking at it and understanding that I'm not bullish. I'm bullish maybe, I mean, for a day trade only, and I say that all the time in my videos, that when we're in this environment, in particular when we have a declining 5-day moving average, all long trades should be kept as a day trade only, which is the reason that even though I thought there was a possibility we would gap higher today, I sold my longs yesterday just because I had to be disciplined. I didn't want to be rewarded for going outside my discipline. And hindsight was perfect. It said, hey, you should have held, but to me it was more important to stick with what I know, and what I know has served me well and kept me in business for 17, 18 years at this point. So we're in a tricky environment, but there are people making good money. I've been one of those people. This week hasn't been a good week for me, and the fact is we all have our bad days, our bad weeks, and hopefully not our bad months, because this is actually a decent month for me. But the fact is, we have to just maintain our discipline and what we know works best for us as individuals. And a lot of the stuff that you read on Twitter becomes noise unless it's something you agree with. And then you look at it and you say, well, do I agree with it because it represents my thinking and therefore it's right? Or do you look at it and say, well, this person tends to be right about the market and I like their approach and the way they look at it. There's a lot of great people that I don't follow on Twitter because they don't match my style. I'm not interested in buying the 8% dividend that might rally 10% over the next year. There's some great people that have stocks like that, but know what you're looking for and understand that people that you're following aren't, you have to understand what they're talking about. I'm talking bullishly in a bearish environment about day trade opportunities, and that's why I said in here, above 109, we need to hold 108.85. We broke that 108.85. That's when I was gone. Very small losses. I mean, these are things that you can come back from and have the capital in place to try again the next day and the day after that and the day after that. And in here we can get some incredible gains as well. The Russell 2000 is the one larger market that continues to hold above the 200-day moving average. So this market has been the strongest. It led us earlier in the year higher, and then it's been more resilient on the downside, but obviously it's still down a bunch, and it hurts to be long here if you bought anywhere this month or late April. But weekly time frame, it's holding on to that 200-day or 40-week moving average in this trend line as well. So this is continues to be the stronger market. It doesn't mean it's a buy though, just because it's stronger, just relative. We're still below. We're closing below these January highs, which isn't good. And we've got the declining 10, 20, and 50-day moving average. And when you drill down to a 65-minute chart, we've still got that 5-day moving average that's declining as well. You look at it on the 10-minute time frame. My hope was, and hope doesn't pay, but this was just a scenario, that we would hold above that 5-day moving average, then rally, and then this 5-day moving average would begin to flatten out and turn higher, and that might have led us to a rally that could have lasted a couple days. Well, obviously that scenario went right out the window when this market broke the mid-afternoon lows. So the Russell is still trying to stabilize near that 200-day moving average. You could call this market neutral at best. It's still under pressure, but at best you could call it neutral. Semiconductors are still kind of trying to build a base as well near that 200-day moving average, and unless you're a day trader, they're a complete waste of time. And for then that could be said for really most of these markets. Unless you're a day trader, they're a complete waste of time. The financial stocks are still stuck below their 200-day moving average. They're below the 10, 20, and 50 are declining. So still trouble in the financial sector. It's going to need to get above 1480. If it can get above 1480, then perhaps you could see a short squeeze rally. Maybe they're going to do something with the the Greek debt. Maybe they're going to start injecting all this liquidity, and we're going to have a massive gap higher tomorrow. And you have to play what the market gives you. But to try and guess on a day-to-day basis and look for the the opportunities to fade a market just doesn't make sense. Last week, someone was asking, what about FXE? And I said that on FXE, I said, the trend is clearly lower. It's a broken market. You don't want to be trading it long. But that we would look at it, and maybe if it created a right shoulder and it got above that 5-day moving average, it would be good for a short squeeze rally. Well, the short squeeze rally occurred, and the problem is news and surprises tend to follow the direction of the primary trend, and the primary trend in the euro is clearly still lower, and people have been looking at it saying we're at support. Support is only known after the fact, but a lot of people got crushed over the weekend and then yesterday in this FXE, and those are the types of markets that you look at and you say, these are broken markets. These are not markets that healed themselves quickly. Getting above a 50-day moving average for a day does not change it. A lot of people get excited when it's above its 50-day moving average. That doesn't change the downtrend. Just like the UNG. The UNG has been it's had this declining 50-day moving average for pretty much forever since the UNG came public. But the fact is, these downtrends, they don't turn on a dime, and that's what you have to be aware of. Okay, so one last look. We'll take a look at gold. Gold is still in an uptrend. I don't know why people are trying to short it other than to be smarter than everyone else, but we've got a beautiful uptrend still here on a weekly time frame, on a daily time frame. This marks our important higher low right now. We've had this pattern of higher highs and higher lows. This is the pullback that now represents the higher low. If you break that level near 115, then I think you start to get more neutral to bearish on gold. But 115 is to me the more important level in there. It doesn't mean be long gold. It's up to you whether you want to be be an owner of it. But the gold stocks themselves, the GDX, most of these stocks are pretty broken. They tried to break out past that 51 level, got above that resistance, and then they caved in. And from this failed breakout came this move lower. So the gold stocks are more neutral than anything. Anyways, let's take a look at the what you guys have here on Twitter, that is, and thanks, by the way, to my buddy Josh, reformed broker, great guy. Met him over this past weekend. Derek, I met him in New York too, and Trading Zoo, I don't know you, but thanks for or agreeing on the BP statements. As does stock investing. Let's see. Can I please comment on GDX? So I did talk about GDX. How about look at HXM, and then we'll let somebody else do this or have a look for somebody else. HXM is in a downtrend. It's below the 10, 20, 50, 200. They're all declining. So HXM is in a bear market. It's broken some important support here. That if it can't get it back, if it can get above this level, which is about, what is this, 26 or so, then it won't cave into 20. But getting above 26 would only put it into a more neutral type of environment, but HXM looks like a broken stock. And when I ask for people to, if you want me to take a look at a stock, I would say that I will bet you 95% of them I'm not going to like. But anyways, let's take a look at some more here. Anyways, we're engaged at an somebody else. TLT, thanks. Going Mackay, TLT is starting to get, I mean, it's had this massive run. It seems as though it's coming into some prior level of resistance at 100, but it's still clearly in an uptrend. You take a look at the weekly time frame. Here's that level where it's been an important level as far as support early last year, early 2000. Then as resistance at back in October of last year, and we got up to this level very quickly. So I would think that most of the upside is likely been played out in TLT for now. I definitely wouldn't short the TLT because we're still in a clear uptrend. We've got a rising 10, 20, 50-day moving average. We've got a rising 200-day moving average. So to me, you look at a 30-minute time frame, we're starting to show a little bit more maybe neutrality here. We still have a rising 5-day moving average, but it's some support at about $97.35, and breaking that, I wouldn't expect it to cave in, but maybe test the rising 10-day moving average, which is coming up to meet it very quickly anyways. I would say that overall, TLT has had a great run. If you've been involved, you start to lighten up and probably raise your stops, because it just seems as though the upside is probably limited from here in TLT. How about a look at FRO? So Going Mackay snuck an extra one in by doing it as a separate tweet. I'll do that. FRO. Frontier, I would say, let's take a look at the week. It's trying to stabilize at the 200-day moving average. I would say neutral at best for this stock. It's got a pattern of lower highs and lower lows. It's trying to stabilize at the 200-day moving average. To me, FRO probably looks like it's trying to stabilize at support, neutral at best. The cynic in me would say a waste of time. ATPG, let's take a look at that one for 99TC. ATPG, look at these moving averages, declining 10, 20, 50. It's below the 200. You can see that 10-day moving average was acting as resistance. It got hit on heavy volume. It rallied up on relatively lighter volume, and then the volume came back into it on the downside. So ATPG is getting hit on heavy volume. It's at an important level, or maybe it finds some support. If it doesn't find support in here, then it's probably headed down towards $10 a share. It's a sick stock in a sick market, and if you're looking for a long side trade, this is kind of like the FXE last week above that 124 level. That if it gets above there, it might be good for a day or so, but the bigger trend is still lower, guilty till proven innocent. So from a short-term standpoint, above 1350, maybe you get a little squeeze up towards 15, but then you probably walk in the next day and you get stuck in the eye with one of these. So it's a broken stock and a broken market. Cipuzzulo, how about a look at U.S. Steel? Steel's got going yesterday, but there's nothing to get excited about on these steel stocks. Best thing you could say is kind of like the market, that they're trying to find support at the lows from February of this year. If you look at the weekly time frame, if the market rallies, then U.S. Steel will probably go as well. Again, yesterday people got excited about these steel stocks. They followed through on the open, tricked people on that gap this morning, and then it just sold off. So since this so-called big rally that it experienced yesterday, the volume weighted average price, the average price that U.S. Steel has traded at in the last 2 days is $46 a share. So the average participant who's bought it on this so-called rally is now down about 88 cents. So that makes it more vulnerable for further downside. All of these stocks that kind of look like this, best thing that can happen to them is they're going to turn sideways for a period of time and then maybe rebuild for a rally, but they're just not looking good. Netflix has been in a huge uptrend. There's nothing here on the weekly time frame that says that uptrend is over. It's just getting really choppy up in here. You could make a case that it's building a right shoulder, and if it fails here, then maybe like they say in a bear market they get them all, and we're certainly acting like a bear market. It gapped above this resistance today and then popped back down below it. So I would be very careful with this, with Netflix that is. These are what look like important higher lows. Now you have to say, if you own it, is this your next important higher low, or are you going to give it some so we can see that this resistance also kind of trying to hold as support today, but the average participant that bought today is down about $1, $1.50. So again, I'm totally I'm not going to like much of anything here. The primary trend is still higher in here, but it's starting to become a little bit more neutral, and we're in such a dangerous market environment overall that you just got to be really careful with all of these stocks. Every single stock out there is dangerous right now. Estee Lauder is below its declining 10, 20, and 50-day moving average. I think you're probably going to see a test in Estee Lauder. This looks likely for it to come down to the prior resistance and 200-day moving average. So Estee Lauder on the weekly time frame, it's still pulling back and probably headed for about $50 a share. It's below that declining 5-day moving average. That 5-day moving average is acting as resistance, and it's just keeps running up there and then got smashed away from it. So Estee Lauder, I don't think you'd want to be involved in it. How about for day trading, Zoo? We take a look at Dell with a stop below 1270. It's below its declining 5-day moving average from a swing trade. I wouldn't want to touch this thing on a daily time frame. I think you're just throwing darts. I don't see anything here. Any reason other than just because it had support before doesn't mean it will become support again. There's just it's a sick stock in a sick market. Anyways, I apologize. We are out of time here. I was just going for a half hour, and we're at that point. Didn't get to everyone's stock here. If you guys want individual stock analysis, I always answer them all in subscriber forum on Monday nights where we have a live webinar. And anyways, thanks for tuning in, and I will see you on Twitter tomorrow.